Some stocks seems to be loved by most investors, but not by me. Let's take a look at them. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rock and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with Vero, my co-host, all fired up because I know that we are going to brew some emotions today, because every time I say that I dislike a stock, everyone goes crazy about it. So it's going to be a fun episode, right, Vero? How are you doing?
Yeah, it should be fun. It should be fun. And yes, my voice still sucks because another hockey tournament won by my son. So this explains that. And Mike, I wanted to go back to one thing, because before the holidays, I told you I wasn't sure what my resolutions would be for the year. And now
Yeah,
I
you
know.
didn't want to commit to anything. Yeah, it was a
No,
bit left on my appetite for that.
so here it goes. Okay, so there are a couple of small ones, but the biggest is to be in the best shape of my life. So
All
nothing
right,
less.
so nothing less. Just
But
set
you
the
know what?
bar right.
I even made a deal with my oldest son to achieve it, because it's one thing to say it. How are you going to make it realistically? So the fall season, my son had trouble like getting up, like it was often late. So we said we will get up together so that we're not alone, we don't get late, and that way I will have time to train in the morning like I used to do maybe a couple of months ago. And if I don't get up, here's the interesting twist. If I don't get up, he is allowed to miss the bus, and I will have to drive him to school, which I don't want to do. So
Yeah, that's that's a pretty good way to make sure that whenever your alarm rings, you're not gonna. It's the snooze button. I'm a big fan of the book Atomic Habits, and this is like one of like the pillar element is to find ways to be accountable for the goal that you want to reach. You not only have an accountability partner, but there's also a consequence attached to it. So
Mhm.
you literally did the perfect way to make it happen. So I'm
Yay.
really looking forward to see how this story develops over the months. But you're definitely on a good start. So I like this. And I can't wait to tease Xavier to say if he's allowed to miss his bus from time to time next time I see him. It's gonna be fun.
Yeah, yeah. It's not gonna happen. Like I don't want to get late. So. Anyways, listeners, we share like many positive tips and ideas during our series last week. So if you missed it, you can go back to these short episodes at thedividendguyblog.com/261. And by the way, we had our record episode during this series. So we got like
Woohoo.
record downloads. So you don't want to miss this. But this time, today, we will look at companies that you may not want to have in your portfolio and why they may soon become a burden if they're not already. Should be interesting.
We're not trying to create like any worries or concerns here, right? It's all good. You don't have to worry about it.
And before we start, Mike will share his opinion on many stocks today. At no time should you consider this to be a buy or sell recommendation. You must always exercise due diligence. All right, Mike, we got inspired by the most popular stocks guide you recently made for this episode. So explain what it is and how to use it.
As you know, we run Dividend Stocks Rock. It's a platform for DIY investors. Many members have portfolios worth over $1 million. So we're talking about like seasoned investors. So we don't go into like members' portfolio, but we see how many times one stock is getting hit or getting added to a portfolio. So across more than 2,500 Pro members, we have this huge database of information about which stock is most popular than others. Of course, from a statistic point of view, we're talking about the number of time you have a share. You have a stock in your portfolio, not the value. So, I mean, on one side or another, it could have been like different way to skew numbers, because if we
Mhm.
have a member with, I don't know, like I'm just saying, like $50 million portfolio, he's like a CEO of like Royal Bank, and he has like $40 million of Royal Bank shares in his portfolio. Well, then it would kind of like push Royal Bank on number one, but maybe it's not really the most popular in terms of like
Mhm.
how many members do have it in their portfolio. It's really by
Right.
holdings, not by value. But again, it's just to have fun, of course. We do the top 50, so top 25 Canadian, top 25 US. And today I wanted to pick on a few stocks here that I don't really like, or that I find that there are better replacement in the same industry, for example. So just put everything into context, because I know that every time I say, "Oh, I don't like this stock," everybody like goes crazy. But I mean, first, you're not me, so maybe you're allowed to love stocks that I don't, and vice versa. I mean, we're all
Mhm.
independent investors, and it's all good because we have like different strategies and different horizon as well. And I can also be wrong. So that's also one thing. And keep in mind, those are picked from popular stocks. So already a lot of them are actually great companies anyway.
Mhm.
It's just that I wanted to show that even though those companies get a lot of love, nothing is perfect. And it's a way to kind of like highlight a few common themes around those companies as well. So just don't jump in your brokerage account and click on sell on everything today.
Mhm.
Just take it like second degree, maybe not just first degree, and everything. We're going to have fun. That's what I
Right.
want to say.
So, listeners, you can download this guide for free, like no strings attached, at thedividendguideblog.com/popular. So, you may want to hit pause, go download the guide, because you will have a lot more details in that. So, thedividendguideblog.com/popular. All right. So, like you've said, Mike, there are picks in this list that you don't like. I think it's important to highlight them, and most importantly, the reasons why they don't suit your profile. So let's start with a now infamous classic, TELUS. Why do you think it's still among the most popular?
Yeah, it's actually the most popular stock at DSR, like the most held. And I kind of understand why. And I had it in my portfolio until just recently. Intellis was this kind of like unicorn where you don't find that many companies showing a balance between growth and income at the same time. So it did well, I mean, for more than 10 years after the financial crisis. Investors are quite fast to forget about, oh, now this company is completely crap because of this and that. And they may be right, but Bellis has been rolling a very good return for several years. And then things started to get wrong around 2021 when interest rates started to rise. But when you look at the companies that have this ability to generate a stable income because they have like that subscription based model, and I mean, everyone will use like cable, internet services, wireless as well. There's only like three
Mhm.
competitors, like major competitors, like counting Rogers and BCE. It's kind of rare to have also a growth component and the ability to increase the dividend. Companies that I can think of right now is like Canadian Natural Resources, for example, or even Power Corporation, which had an amazing year in 2025, but usually it's more like a dilute bond. So it's quite rare to have like this unique combination. And I was quite bullish on TELUS for several years because I love the fact that they diversified their business model using technology to open segments such as TELUS Agriculture, TELUS International, and then TELUS Healthcare. And actually, to be honest, TELUS Healthcare is actually doing pretty well right now. So it's not all bad about TELUS.
So you sold your TELUS shares a few weeks or months ago, I can't recall. But why would investors get rid of it?
Yeah, so here's the thing. I sold my shares after TELUS announced the dividend freeze. So I'm not
Mhm.
saying that investors should get rid of it or buy more or whatever, because that's personal. My focus is on dividend growers. And I like to have like very easy to follow rules. So if you don't increase your dividend, well, you probably should not be in my portfolio. And the reason why there is a dividend freeze is even more important than the call itself. So just
Mhm.
keep in mind, not because I do something or I often hear, oh, Buffett does this, Buffett does that. And I'm like, yeah, well, you're not Buffett, I'm not Buffett. And you're surely not doing every single thing that he does. So from time, there's just an example that I find funny is a lot of people will say, well, Buffett has like 30% of his portfolio in cash, so I should be in cash too. And I'm like, yeah. And he held like 40% in a single stock for like more than 10 years, which was Apple. I'm pretty sure you did not do that as well. Because I mean, if you have to do like one thing, you have to do the other as well. If not, you're not really doing like Buffett style. So, anyways, so for me, Dallas, the inconsistency is a big no. What I was looking at in 2025 at the beginning of the year, I explained to my members, okay, so I'm not satisfied with the returns that I have with Dallas. Obviously, there are problems, but I'm going to track down cash flow metrics every single quarter to make sure that
Mhm.
cash flow from operation and free cash flow increases so it can cover interest charges and the dividend. And at the same time, I want to see the capex, the capital expenditure, going down. They even come up with a full plan about that. So they wanted to increase free cash flow, of course, supported by TELUS Digital, Telesal, TELUS Agriculture, and the main business, which was happening in 25. They started to reduce their capital expenditure because they were at the end of their investment cycle for the 5G. So again, that made sense. That happened over the past 12 months. They started to monetize some of their assets. So they sold a big chunk of their cell towers, 49% actually. So they have the control, but they still sold a big bunch for slightly over $1 billion. I think it was like 1.26, if I remember correctly. And
Mhm.
they used that money to pay down debts. So again, they were like very consistent with their plan. That was making
Right.
sense. And so you have that combination where, yes, it's a tough plan, but they are doing this like one step at a time where they improve cash flow, they reduce expenses, and they pay down debt. So really like when you have like your credit cards that are full and you look at your budget and you're making those tough decisions, this is what they
Mhm.
were making. So that was all working well for their plan. They also plan to eliminate completely their drip feature in 27, sorry, because one other thing is by issuing more shares through the drip system, it enables TELUS to use less cash flow to pay the dividend, but it creates a bigger problem down the road because now you have more shares. So therefore, even if you don't increase the dividend payment, you will have more dividend dollars to pay over time.
Mhm.
So everything was there. And then boom, they kind of like revise all of this saying, yeah, so at the beginning of 2025, we said that we would increase our dividend by 3 to 8% through 2028. And now we're just going to hit pause. And that was a big alarm sign for me. I did not like this. Already, I was on board on that plan, but I was not excited. I would have probably not bought TELUS at that time, but I was like, hey, it's already there in my portfolio. I see it as a deluxe bond. They seems to have a very solid plan. They do a lot better than BCE. Let's go along with this and see how it goes. So the minute they announced the dividend freeze, I just opened my brokerage account. I'm like, okay, there you go, you're gone. And that's the reason why I decided to get rid of it. So is it
Mhm.
a bad move, a good move? I mean, when you think about that, they're just making sure that they limit the cash flow getting outside of the business as much as possible. So that's smart from management point of view. What is not smart is to get to that point. That's still their fault, and that's the reason why I decided to move on.
All right, so which other stocks would you replace it with?
If you want to stay Canadian in telcos, I would say Quebecor is probably the best one right now. Not a big fan though. The metrics are good. They keep increasing their dividend. They're more profitable than the big three, but I just don't believe that their cable business will thrive going forward. So I'm having a hard time to see where's the future growth going to come from. But so far, they've been doing well. My personal pick, what I did with my money is I sold my shares of TELUS and I started a position in Alphabet, so Google. That will be left for another story because we have another episode that is coming up. So I want to
Mhm.
make sure that our listeners are coming back. So I'm going to tell you everything that I love about Alphabet in another episode that is coming soon.
And by the way, don't count Videotron to send you your phone at the right address, but that's another story.
That's also another story. But, I mean, customer service from telcos in general, it's
I
kind of like
know.
expected to be mediocre. Actually, mediocre is kind of good for them. I don't know why, but they're all the same. It's ironic.
Anyways, so another one I was surprised to see on your list of stocks that you dislike, well, that you dislike in this list, right, is Canadian Tire, CTC.A.TO. Is it because of its lack of diversification, Mike?
Yeah, so again, just want to highlight the fact that we have to be careful with words here. There's a context. I actually add Canadian Tire in my Smith Manover portfolio not too long
Mm-hmm.
ago, but it's more about the disappointment. Because I mean, when I look to the top 25 Canadian stocks held by my members, I have to say most of them are amazing. They're very, very strong companies. So I've picked among those that I believe that they're the weakest. And right now, that's pretty much what's happening with Canadian Tire. I expected a stronger movement for like the buy Canadian type of thing. Didn't reflect that much, actually. So the company shows a weaker dividend triangle. The latest dividend increases were quite small as well. They face a lot of competitions. And when you look at the stock price, it goes through much of a roller coaster. So it's not an easy stock to love. There are a few good things about Kintyre, but the main reason why I decided to sell in my Smith Manover is when I first started this a few years ago, my goal, because we live in Quebec, so the only deduction I can use the interest on is the dividend income, the investment income. I cannot, because the rest of Canada you can use the interest that you pay against any type of income, but on in Quebec we have to be special for everything, even for the worst stuff. So we are limited with the deduction. So my goal was to have slightly higher yield in this portfolio versus what I usually do across all my other investments. Because I prefer to focus on the dividend triangle, being yield agnostic. But for this one, I kind of put the minimum yield for my selection at the beginning, and then realized after a few years that the results were okay. I was not disappointed by the results, but I could have done a lot better if I had followed
Mm-hmm.
my original strategy. So at the end of 25, I decided to do that cleanup. Anyways, we're talking about like 1,000 here and there. So it's not like life-changing moment in my portfolio, but I just did some cleanup saying, hey, I'm going to get rid of like $1,000 or $2,000 that I had in the entire and replace that with a company showing a stronger dividend triangle. So that's the reason behind.
Okay, but then what are the good reasons to keep it?
There are a lot of them actually. First, Kintyre has an iconic brand still in Canada, so very well known by consumers, loved by consumers. They benefit
Mm-hmm.
from a wide distribution network across the country. Of course, we're talking about economies of scale. And one thing that I really love about it is the fact that they have their own brand, so that improves their margin greatly. And for retailers, I mean, that's the name of the game. So that was another thing that I like about Kintyre. So it's just a matter of the economy is not that strong. They struggle showing strong comparable sales growth consistently, and the
Right.
fact that the dividend increases have slowed down over the past 2-3 years. Those are the reasons why I decided to get rid of it. But for someone who is more interested in getting income than getting total return, that could be a valid take, definitely.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. And what are the better options in the same industry?
Yeah, it's kind of strange because on the one side you have Key and Tire that is labeled as consumer discretionary, which totally makes sense because I mean, yes, they sell like day-to-day stuff, but they also sell like higher ticker stuff. If I look at how financial nomenclatures are being done, Dollarama is also, depending on the website, is sometimes a consumer staple, sometimes a consumer discretionary. So if you go on the consumer discretionary, I would definitely pick Dollarama over Kintyre any day of the week. That's for sure. I've discussed Dollarama plenty over the past few months, so you can go back
Mhm.
on the Dividend Guy blog, and you can also go back on the Moose on the Loose. So it got covered a lot of times. And another one that has been covered a lot of times that is actually labeled as consumer staples. Yeah, you're laughing because you know my answer here. It is labeled as consumer staples, but it could arguably be consumer discretionary, especially with what we see right now is alimentation couche-tard, because we see that
Mhm.
consumers are tight with their budget. And then all of a sudden, revenues and earnings are having a hard time to grow at the same pace as they used to. So definitely Kushtar would be also a stock that I would prefer over Canadian Tire. So pick the one that you believe in most between Dollarama and Kushtar.
All right, so now a Canadian bank also made the list, and here,
That's my time to laugh.
well, I mean, it's an excellent example of a company that is not necessarily bad, but just not as good as its competitors. So that bank is BNS, Scotiabank. Why is it among your least favorites, Mike?
Yeah, as much as I love to talk about National Bank, I love to dislike Scotiabank. I don't know. I mean, it has become like this running gag. I just love to beat a dead horse. But it did better recently. So now a lot of investors are coming back at me, but I just found it funny. So as you summarized it clearly, what I dislike about Scotiabank is not the business itself. It's a Canadian bank. There's only one of them. They're amazing. They're robust. They're strong. They will continue to pay and increase their dividend. It's just that Scotiabank, for one, they are the one with the highest payout ratio. They are the one with the highest yield. And they are the one with the lowest dividend growth rate over the past 5 and 10 years. So those are reasons why I dislike the stock. So it's really about the narrative versus the numbers. So the narrative has been, oh, international exposure is going to be amazing. They have been banging that drum for more than 15 years now, still not happening. So it's not a good narrative. They are not outperforming other banks on a consistent basis because of their exposure to international, mostly Latin America. And to prove my point now, they're making a cleanup right now. They're selling some of their businesses across different countries in Central America and South America for that reason, because even themselves, management, they realize it brings more volatility than anything else. Again, going to go back here, it's not a bad bank. It's not a bad investment. It's just that if I have to rank the big six from 1 to 6, I've ranked Scotiabank dead last for the past 15 years, and I'm going to die on this hill. That's for sure. But I
All
mean,
right,
if you look for income, it's all right.
that was pretty clear. But Mike, you've said it. It was up big time in 2025. So what would you do if you had it in your portfolio? Like, would you like take the profit and run or keep it?
I cannot envision myself in a world or a parallel dimension where I would have Scotiabank in my portfolio. How could I like left alone Royal Bank and National Bank on the sidewalk while I would go on a trip with Scotiabank? That feels like cheating for me right now. But I mean, more seriously, if you're in for income, again, if your goal is to generate a steady income that will increase and match inflation or even go better than inflation, Scotiabank is a perfect candidate. So for those who are looking for this type of investment, I mean, stick to it and that's perfect. And I totally get why it makes the top 25 most popular stocks at DSR. I would have just select any other banks beside this one, but that's pretty much the thing. And I always smile when people are just like, yeah, but look at 2025, it's amazing. And even at one point, I don't think at the end of the year, I would have to look back at the numbers, but I don't think at the end of the year it was true. But at one point during 2025, Scotiabank was doing better than National Bank. And that just made me smile. Yeah. And then people were just like very proud to say that. And I'm like, all right. But you know what? I'm not getting excited when the Abs are first in October because you know what? No Stanley Cup has ever been won in October. So investment is not a sprint, it's a marathon. So show me a graph of Scotiabank beating National Bank for 20, 25 years, and then we can talk. Besides that, I don't know if it's relevant, especially for a few months. I mean, it's fun. It's the whole point of having discussion. This is why we have a market anyways, right? Because if we all think the same, well, no trades are going to happen because every single time that you sell a stock, keep in mind that you're selling it for your reason, but somebody else on the other side is buying it thinking they make a deal. If not, they would not buy it and vice versa. So when you buy a stock, you're thinking you're having a good deal, but somebody else is actually laughing and they're just super happy to get rid of it. So you always have to ponder both sides of the trade.
Right. So now moving on to Starbucks, which used to be one of your darlings. What made you change your mind?
Yeah, I had to relink. That's tough. See, I really had a hard time. Reluctantly. Anyways, I had a hard time to sell it because I cannot speak right now.
Don't count on me for that.
Yeah, I know. It's all right. I mean, we're French, and if you don't appreciate her accent, well, too bad for you because it's been already half an hour that we're talking. Yeah, Starbucks. I selected Starbucks in 2017 when I quit my job as a private banker and received the commuted value of my pension plan. So I received my check. I built a portfolio of like 15, 20 stocks. One of them was Starbucks, based on a great growth story, robust dividend triangle, of course. I still love the coffee. I still believe in the business, but the metrics are not there and the thesis is not there anymore. Because one of the important things for me when I bought Starbucks back in 2017 was the fact that the company had this clear plan. And back then they were opening like 600 new stores in China every year. It was like going
Right.
amazingly well. Well, that story is not true anymore. Actually, even more than that, they sold a big chunk of the Chinese business last year and they're struggling to grow in the US. They're facing a lot of competition, a lot of like internal challenges, labor and unionized issues. So that story is not about growth anymore. They came up with a plan. So I was like, all right, again, following my rules where when I see the metrics and the dividend triangle, which are like the revenue growth, the earnings per share growth, and the dividend growth are slowing down, I'm willing to wait. I wait to see if there's a plan. I wait to see a few years, most of the time, maximum 3 years. And we came to that limit for Starbucks. And on top of that, the latest dividend increase was like minimal. I think it was like around 2%. It used to increase their payout by double digits. So we're
Hmm.
pretty far now from the growth story that I love. So
Right.
just following my rules. I mean, I made a pretty solid profit on this one, but it was time for me to go. It's just following my investment rules. Hopefully, they're going to make a comeback, but I'm not going to be there to benefit from that bounce back anyway.
Okay, but Mike, when we get to strong brands like Starbucks, it is important as investors to separate what we think of it as consumers from the investment it really is. You've said it, you may love or hate its coffee, but that doesn't make it a good or a bad investment, right?
Yeah, that's totally true. I mean, BC is a pretty good example because my wireless services and my internet services are with BCE. And I cannot say that I hate them because I mean, mind you, I never called customer service, so that's probably why. But the reason why I never called them for like the past 10 years is everything has been running so smoothly. So I cannot complain. But it's a very bad investment, but a
Mhm.
good company to provide a good service, in my opinion. You know, I get the feeling that it feels good to buy shares of company that you love or that you use, but it's completely irrelevant. You know, my youngest son Caleb a few years ago, he was like we were like walking in the mall and he was like, "Oh my god, GameStop so amazing. Like it's such a good idea to run a GameStop stores because everyone wants to go there to buy games." And I'm like, "Yeah, well, everyone of your age maybe, but think again, it's not like the best business ever, but from his kid's perspective, I mean, it was just like going into that store. It was literally Christmas Day every day of
Mhm.
the week.
Right.
So that totally makes sense. But buying GameStop, I mean, at one point it would have made a good investment, but not necessarily for the long run. So
Mhm.
never make that link in your mind that, I mean, I don't have McDonald's in my portfolio, but I do like the stock. I think it's a great brand. And it's a miracle if I go in a McDonald's twice in a year. Like most of the time, it's going to be once a year, not even. And it's going to be added with a context or something where I cannot find anything else. So
Mhm.
I don't go there and I still believe it's a good company. Just look at the big picture, not your personal experience.
Right. So another good way to replace the stock is to work on your sector allocation or stock weight and make sure that what you hold matters and actually makes a difference. And this is what you did with your Starbucks shares, right?
Yeah, so at first you have to say, okay, so you have like two decisions. Either you keep or you sell. And then the second step is to where should you put your money in? I mean,
Hmm.
because, and this is something that I work on a lot because I find it a lot easier to get rid of a stock, especially like a company like Starbucks that I really loved for a while. If I find a replacement already, it makes it so easier because I know already where the money is going to go in. I get excited about this new stock. It's like a new toy that you really want to buy. So you're going to make extra sacrifices and extra action. So it forces you to get out of that paralysis by analysis phase. Ironically, I was looking at my portfolio and I realized over the past 2, 3 years, I've been selling my consumer discretionary stocks in that sector. That used to be my third largest sector, and to go a little bit more into industrial companies because I saw more opportunities over there. And eventually it may turn around. So it's not a major sector rotation per se, but I just realized that maybe like industrial stocks were like 5, 6% of my portfolio back then. Now they're up to 12, 13. And then consumer discretionary was 12, 13%, and now back to 5. So just a small rotation here, depending on how you look at the market, what's important for you, which kind of investment themes you think are going to be important in the future, which kind of narrative are going to
Mhm.
drive. But my decisions always start back on the dividend triangle and financial metrics. And then I will add an investment thesis. I will add the understanding of the business model. I will add the narrative around it. So I always start with numbers and then I add some stories around the stock that I want to buy.
Okay, but Mike, according to you, are the stocks we highlighted today, because most of them are not necessarily bad, but just
Mm-hmm.
not as good as their competitors. So are they part of the top 50 at Dividend Stocks Rock because some investors still struggle to sell? Like, what tips would you give investors in the same situation?
So not necessarily, but I can see something because from like we've been doing this top most popular stocks for a while at DSR. So every year our members are getting the top 50. And one thing that I've noticed throughout the years is even if a stock cut their dividend or perform badly, it takes a while for investors to sell it. So I realize
Mhm.
that it's really, really hard to sell a loser. And we've been, I mean, I wrote newsletter on that. We did tons of webinars on that. We keep on receiving a lot of questions. So I'm trying to create structure and model frameworks to help people having like a more straightforward decision process so they can actually take action. But I
Mhm.
totally get it. It's tough to sell, and it's even harder to sell a loser because we've been told by an old, I mean, be patient, it's going to recover.
Mhm.
It's not
Right.
always true. That's the problem. And there's a thin line. I mean, it gets foggy when you get there. You don't know which stock you should hold that will recover and which others are just dead money and then you made a mistake. So going back to those 4 stocks we discussed today, I mean, I believe that the most robust one is probably Scotiabank, even if it's painful for me to say, but I mean, I have to say it. I mean, it's a great bank. I mean, it's a great business, not a great bank. That's the way I would put it. Yeah. Starbucks could make a comeback. I mean, they have like smart management in place. They made some changes there. They have a plan. I just, for my taste, it just takes too long to turn over, but
Mm. Mhm.
it's not over yet. Canadian Tire still have many qualities. It's probably more kind of like a deluxe bond at this stage where it's a mature business that will pay a good dividend. The dividend will increase, but probably just match inflation. So if you're looking for income, it's still a valid choice. TELUS is definitely in a limbo right now. I believe it's going to be harder to sell for a lot of investors because the other question will be, how can I replace it?
Mm.
Mostly focus on the yield. So, I mean, on my side, I replaced TELUS by Alphabet, which on a yield perspective doesn't make any sense. And I totally get that. But since I'm yield agnostic, I really don't care about that metric. But I do understand that some people focus on income. And then it's going to be incredibly hard to replace the dividend paid by TELUS by another stock. So
Mhm.
that could add another layer of difficulties of pulling the trigger on this. So in terms of tips, I would say if you do not have simple and straightforward selling rules, it's now time to work on those. It's going to make your life so much more easier just to follow them. Like whenever I do my yearly review, and we just came back from this like a month ago, I do my yearly review. I just follow my rules. I don't ask
Mhm.
myself if I like the stock or if I believe something. I don't. It's completely irrelevant what I believe because I use those numbers. I look at the rules and I follow them. And those rules have been built based on facts, based on my stories, my experiences, and the fact that they're actually working. So most of the time,
Mhm.
those rules are actually there to protect my portfolio from my feelings because it's a hard thing to separate the rationality and the emotion when you manage your money.
Right. So again, the most popular stocks guide is a good way to see what seasoned investors hold, maybe also get new ideas or just food for thought about your own portfolio and how to set up your selling rules. So What do you like the best about it, Mike?
One thing I like is obviously to get some good ideas, especially when I look at not the top 10 because they're quite obvious, but as you go down the list, you will get some ideas or some stuff just like, oh, really? Like that many people love this company. Maybe I should dig in. So that's one thing. The other thing is I really love to see the ranking evolve from one year to another and actually realize that as much as I talk about Couche-Tard and National Bank, they're not at the top of the list. So I love to see that my members, they can use their own decision frameworks to make their decision, which is amazing. So
Right.
I'm here to provide tools, but I'm glad to see that people are just not following blindly what I have in my portfolio because that doesn't make sense in my opinion. The same way that when some people say, oh, but this investor has this stock in their portfolio, what do you think about it? I'm like, well, good for them. I don't have an opinion
Mhm.
on somebody else's portfolio. So it's important to have your own rules and to follow them. So this is one thing that I love about the most popular stock. And I mean, let's be honest, it's always fun. We're all a bit curious. So it's fun
Yeah.
to see, oh, my favorite top 5 stocks are part of like the most held popular. So that's kind of fun. So it feeds your curiosity.
Right. So, listeners, you can get more inspiration now. Download the most popular stocks guide for free at thedividendguideblog.com/popular. Thank you, Mike, for your straightforward opinion on these stocks, especially Scotiabank. For show notes and related content, visit thedividendguideblog.com/262. And next week, we will discuss tech stocks immune to the AI bubble. So hit the subscribe button underneath our podcast logo so as not to miss it. And until then, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.